I wish when I started investing 10 years ago, I knew everything I did now, but obviously you have to start somewhere, and there's no time machine that we can use just yet at least. So here are 8 things that you need to know about investing that get asked all the time, and some that you might be too afraid to ask. First up, are index funds and ETFs the same thing? This one always gets confusing and lots of people still mix this one up. So here's the best way to explain it. Index funds are a type of investment, but they're sold in different ways. Remember, all an index fund is a type of investment that collects lots of investors' money all together, invests it all together across lots of companies, usually depending on how big the company is inside an index. A simple example and most famous is the S&P 500 in the US. If you buy an index fund that tracks the S&P 500, you'll end up investing in these companies, everything from Apple, Microsoft, Amazon, and Google, in these different percentages. So $100 would buy you this percentage of each company. Now, an index fund can be bought in different ways. So imagine that an index fund is more like a big category or one big circle. Inside the circle are the different ways that you can buy an index fund, pretty much as mutual funds or ETFs, exchange-traded funds. Now, just a note here that not all ETFs and mutual funds are index funds. There are also lots of ETFs and mutual funds that sit outside of index funds. So if we're still imagining this circle, we can have an ETF inside the circle and outside the circle, exactly the same as the mutual fund could be. Now, by this point, I've probably lost you. There's too many circles, but here's the too long didn't listen to answer. You can buy index funds as either a mutual fund or an ETF. I guess kind of like a pizza. You can buy frozen ones or fresh ones. They follow the same thing. Now, ETFs are usually easier to find because they're bought and sold on the stock market, whereas a mutual fund is priced once a day and bought directly or through an investing platform. Okay, next one. This is a question that can get very complicated very quickly, and I've done a few different videos on this one specifically. However, in short, if you are a long-term investor, so someone who wants to invest for many decades, and you're going to do this by investing consistently using low-cost index funds, it is always a good time to start investing right now. No question at all. Why? Well, over the long term, whether you invest your first £100 or $100 right at the top of the market or right at the bottom in any given year is going to have almost no difference to what you end up with. Time in the market is going to be most important thing rather than trying to time the market. Obviously, this is a completely different story if you're going to pick your own stocks, as you have to do a lot more work to figure out if now is a good time to buy. But if you stick with index fund, rest assured you can start whenever you like. Okay, keeping with the theme of one of the most common questions that gets asked all the time, when investing, do you put everything in at once or do you invest regularly, often called dollar cost averaging? This question assumes a couple of things. One, that you have money sat there in your bank account that you want to invest, and two, that we're again using index funds as there's no way to give an answer for an individual company stock. This would pretty much all depend. Anyway, the short answer here is that if you have money ready to invest as a long-term investor, the data says, at least from the past, that you're better off investing it all right now rather than spreading it over a longer period of time. The best data I like to reference is from Vanguard here, and it shows the difference between investing all at once or spreading the same amount of money over a 12-month period. Again, to keep things short and sweet, the end result, the conclusion, says that between 1926 and 2011, you would have been better off 67% of the time during any 12-month period just putting all of your money in at once. Now, to add to this, I'd say that if you're making your own mind up on how to do this, just do whatever feels best for you in your own situation. You could do a bit of both or dollar cost average over a shorter time period. Really, it's up to you. So whatever lets you sleep at night, I think is a good test. Remember, I'm not a professional financial advisor, so please do seek out help if you need it for your own situation. Now, I'm not going to pretend this whole investing thing is easy and it's all going to be up from here. Yes, you can lose money and everything you do has risk, just like everything you do in the rest of your life. Hopefully, if you've learned anything from the past couple of years, you would have seen just how quickly a stock can go up, as well as come straight back down, and many stocks never recover and end up at zero. However, putting these individual stocks to one side, if we're talking long term, if we're talking about using index funds, then you put yourself in a very good position to make money. Just be warned though that you might have to go through many months, even years, where your account sits in the red, and you think it's all just going to get a lot worse from here. You only lose money if you actually sell your investments, and you should definitely get used to seeing red in your account. You'll end up a better investor if you do. Now, one final thing to say on this point is that not investing at all and keeping your money in cash also has its risks too. This is because inflation will eat away at your money all the time if you don't do something with it. So whatever you decide to do with your own money, just remember that this is the real reason why you need to do something. Otherwise, It's a guaranteed loss. Right, next up, do you have to pay taxes? There's no way you can answer this question exactly because it all depends on your own unique situation, what accounts you use, as well as where you are in the world. But even without knowing all of that, here's a couple of things worth saying. Here in the UK, for example, we have individual savings and investing accounts which allow us to invest tax-free. Now, I've done videos on this topic, so feel free to watch them later. And many other countries also have similar schemes that means that you could either have any gains or dividends without paying any tax, or you can defer the tax until when you retire. Don't forget as well that in many countries, you'll also have personal allowances to use on things like capital gains and dividends. So even if you did make some money with investing and weren't using those accounts, you can still not have to pay any tax. So the bottom line here is make sure you know what accounts are available to you as an investor and how to save money on your taxes, and 2, also understand what your allowances are too, just in case you aren't using those accounts for whatever reason. In my last video on the channel, I'm actually in the process of selling all of my stocks in general investing accounts to put them in tax protected ones, so make sure you subscribe for any future updates on that one. And while you're down there, don't forget to hit the like button for me. Right, let's talk money, because after all, that's what we're here to make as investors. So how much do you need to invest to actually make money in investing? The answer is really it depends, but let me just show you some examples to give you some inspiration. Everyone can invest different amounts at different times and we've all got different goals, but let me show you the difference that different amounts can make. Yes, I just used the word different 6 times, including that one. Let's say you can invest £100 or $100 each month and you'll invest for 30 years with an average rate of return of 9% a year. I want to keep things really simple, so we're not going to worry about inflation or anything like that. Let's just see how much money we end up with. We'll see on screen now that we end up with $184,000. But that's not the best part. The real detail is that of that total amount, you as an investor only put in $36,000. So all of the rest is earned in interest. Now, if you'd not invested and just put £100 into a bank account every month for 30 years, then $36,000 would be all you had. And that is the real power of investing. Now, just for fun, what would it take to get to $1 million over 30 years? The number is $545 or so, or close enough to that. Just check out the amount of interest earned here if you can stick that sort of money away for that long. Anyway, hopefully you get the point. There's no correct amount and even small amounts can grow. It's more important to focus on how long you can do it for rather than the amount itself. Look, nobody wants to really focus all of the time on the bad parts of investing, but you might be thinking, well, what happens in a stock market crash? Am I going to lose everything? Well, because investing's risky and the stock market is, after all, one big market, there's going to be lots of different times of booms and busts. Everyone's playing a different game. Some people want to make money in the short term, some people will panic, and other people will just keep buying no matter what. For every person that wants to buy a stock, another person has to sell it. It's as simple as that. Let me show you something about the history of stock market crashes over the long run. Here on this chart, all of the grey bars show us stock market crashes, everything from the Great Depression back in the 1930s, both world wars, and the lost decade that followed the dot-com crash. There's 2 things to notice here without going into too much detail. Number 1, crashes are just part of the market cycle. There's no way to predict them, and they happen often enough that you're a long-term investor, you're just going to have to put up with them. So consider this the price of admission if you want to enjoy all of the profits in the market. And 2, throughout all of the pain of the last century and more, the stock market overall continues the long-term trend upwards as new technology, new inventions, as the global market becomes more valuable. Remember that lesson that really, unless you actually sell, you don't lose money. It's just a loss on paper. So the real key is keeping buying even during the downturns when a lot of other people have already given up. Okay, right now you're watching a YouTube video and there's no doubt there's lots of amazing creators on the platform that can help you get started investing and become a better investor. But also just be really careful out there because there's also lots of people who don't care about your interests, will pump anything for money and really haven't got a clue about investing. So let me just suggest to you another place you can turn to help validate the things I've said and gain more knowledge too. Get yourself some of the best investing books out there. And I get it, books are boring, who cares about books? But trust me that as an investor, these might be some of the best investments you actually make, and you can easily make back thousands of times of what you spend. And funny enough, rather than me tell you what the best books are that I've read out of dozens on my shelf, here's a video I did recently where I went through my top 5, and you can go ahead and watch this one next. And thanks so much for watching, and as always, happy investing.